So I think my remit was just to talk briefly about the global economy and where we are, and then put a relational view on what's going on. I think the general purpose was to get me here and get me to speak so you could ask me questions rather than me speak a lot. So I'll briefly go through what's going on at the moment and then just highlight a few of the background trends to help you understand what's going on, and then we'll have a bit of a relational analysis of some of the pressures that have been building. Just thinking about where the global economy is at the moment, just as background. I mean, essentially the big headline is it's all pretty dull at present. Now that sounds very strange because all these geopolitical risks are going on. We've got earthquakes and hurricanes and North Korean missiles being fired and so on. But actually, the global economy has sort of turned finally, and people are upgrading their expectations of economic growth for this year and next year. For the last 10 years, they've been downgrading them, so everyone has been too optimistic since the financial crisis. All the authorities, IMF and so on, have periodically had to downgrade their forecasts, but finally things have turned, and that maybe just be a sort of one-off. We've got to be right sometime in the forecasting, but in terms of the wider global economy, things are going generally well. So 80% of countries are what economists call at trend growth or above, and some central banks are starting to slowly edge up interest rates. So the United States has finally got around to, I think they've raised interest rates 3 or 4 times. Canada has just raised rates for the first time for a while. Commodities, which I know are important to some people in the room, have bottomed out, and if anything, metals are picking up. So copper and iron ore have picked up recently because China recovery is carrying on. Labour markets are surprisingly tight. So unemployment in the US, the UK is at record lows. Employment is at record highs. The unemployment rate is low partly because a lot of people, particularly men in their middle age, are coming out of the labour market, like me, for various reasons. And so labour markets have stayed tight partly because labour supply has been coming down. Even European labour markets, mainland Europe labour markets, are starting to tighten. So Spanish unemployment has come down from a high of 26% to roughly 22%. Stock markets and everything that's a financial asset is essentially at their all-time highs. So stock markets globally hit their all-time high this week. If you take the index of all the indices, global bonds are at all-time highs or record low interest rates, particularly for corporate bonds. So anything with risk in it, that the risk premium is very, very tight. So the phrase you often hear in sort of global markets now is return-free risk. That is, company bonds have been bought and they're giving no return for the risks they're posing. So Argentina, who just defaulted a couple of years ago, was able to issue a 100-year bond a few months ago. Now, everyone who bought that bond knows that Argentina will default on that bond in its lifetime. But they're so desperate for anything with yield. If Argentina is willing to pay 8% interest rates when you can get virtually nothing elsewhere, people are almost forced to buy it, because if they don't, then they're losing out against their benchmark, because the Argentina bond comes into their benchmark. So you're forced to buy things even though you know there's huge risk. Puerto Rico was able to issue a 30-year bond in 2015, I think it was, even though everyone knew that they were going to default in the not too distant future. And Puerto Rico did default last year, and they're restructuring $72 billion of debt in a very messy legal process. But because there's so much demand for anything with a return, then very risky borrowers can get debt away. Just to get a bit technical now, volatility is also at record lows. So when you think about any financial market, how much the prices move is also very important for people who are trading it. Investment banks love volatility because that means that they can make money from a big spread between buying and selling prices. Volatility is again at record lows. So prices are not moving very much at all. So the US stock market, for instance, has edged up, but for the last 6 months has been effectively flat, and it's gone very long periods without any big moves. There are technical reasons for this, but people are effectively what's called selling volatility. There's a lot of funds now that are sort of taking the trading volatility and forcing the amount of traded volatility down. So the world is looking very benign, very calm on the surface of financial markets. This is why it's very dull in one sense. Not much is happening. We haven't had any big moves recently. And so you're finding that there's just this turn in expectations of where interest rates are going. So Bank of England yesterday signalled that we may be close to an increase in interest rates in the UK, and that would be the first for 12 years. So interest rates in the UK have been at effectively 0.25% for a huge period of time. So since 2008. So effectively we've had a decade of interest rates only coming down or being very low. So on the surface, it looks calm. So even though we've got all the headlines, geopolitical events, the world economy and markets look very benign at the moment. There are clouds on the horizon, or some indications that things aren't going particularly well. In that, this calmness has been the result of continuing to pile up the amount of debt the system has, particularly in China. I mean, effectively, a little bit of an exaggeration, but now the only real change in global economic conditions occurs in China. So as long as Europe and America and Japan don't have a big collapse, they just carry on roughly growing at where they are, the main change in world output comes about what happens in China. That is the swing economy now. And China is slowing on trend because of population and because it's maturing as an economy. But it has built up enormous domestic debt to carry on growing the way it has. So if you look at the Chinese level of domestic debt relative to its income, it is roughly double what South Korea or Japan were at the same level of economic development. China still has lots of assets abroad, so it's still sitting on $3 trillion of foreign currency reserves, but the debt it's built up domestically is enormous. And this is different from other sort of a Western type of system, because most of this debt is in companies, not the government. The government debt in China is relatively small, but it's primarily in corporates. Some of these are state-owned, some of these are private. And so essentially the big channel for debt has been to take Chinese savings, sell some very dodgy savings products off balance sheet of banks, and stick it in corporates and commercial development. Now, one thing that economists are now focusing a lot more on is what we call the credit impulse. This is the rate of growth of credit in the system. Is it accelerating or decelerating? The Chinese sort of credit impulse is now decelerating very hard because the Chinese authorities have got very worried about this big build-up in debt, and for the last 8 months or so have put the screws on, tried to tighten lending conditions and try to slow this down. And so the credit impulse is now extremely negative. So credit is still going up, but it's slowing very rapidly. And so people are expecting this to feed through into a much slower trajectory for Chinese debt, for Chinese growth, and that came through in numbers published yesterday. The other big headline is that inflation and wage growth have been very, very subdued, very, very low relative to expectations. So if the world economy had been growing the way it has done, and interest rates were very low, and we've still got lots of central bank stimulus going on, if you'd taken us back 10 years, people would have been expecting rapid inflation, rapid wage growth, because they'd be expecting tight labour markets would mean, people are going to need to be paid more to keep them in employment, and they'd be able to demand higher wages and so on. The big surprise has been that inflation and wages have been coming in much lower than expected. So central banks have been sort of expecting, right, wages are going to be picking up, prices are going to be picking up, we're going to be raising rates soon. And the Federal Reserve keeps on saying, oh, we're expecting to raise rates, but never gets there, or never gets there as much as it expects. And I'll talk a little bit about why prices and wages have been very benign and very low for a long time. The inflation, of course, has come through asset values. So as I said, everything that's a financial or a property asset is very expensive. That's the result of very low interest rates. So your discount rate is very low, therefore anything producing a return, be it dividends, be it rents and so on, when interest rates are very low, the value of those things goes up. And hence property markets in the UK, Australia, Canada are record highs. As we said, stock markets record highs. So if you've got assets, this is a brilliant time because you're feeling very wealthy. If you haven't got assets, but you're hoping to buy a house one day, you're feeling very, very poor. So I was with two young families in Cambridge yesterday, and they were asking me, how on earth do we ever save enough to think about a down payment for a house? It's just way beyond their expectations. So they're sort of, and I was trying to talk to them about, yes, it's okay, you can live your life just renting property. That's not a crime, and you don't have to buy a house. 60% of the German population do not own their house, and so on. So it's sort of, you don't have to do it. But it feels, and this is one thing I'll talk about, that there's a big demographic distinction between generally the old who have assets and the rich that have assets. Particularly in the US, most of the financial assets are owned by the top 10% of the society, versus the young and middle income or low incomes who haven't got those assets. So in a sense, all the central bank stimulus to get interest rates down has helped those with assets already at the expense of those who don't have the assets. One thing to keep remembering is that even though these are benign times, central banks are still massively stimulating the system. So primarily this is the Bank of Japan and the European Central Bank have bought between them over $2 trillion of assets this year alone. So even though this is benign times, they're still stimulating the economy. We still have very low or negative interest rates across much of the system. So the Swiss central bank yesterday confirmed that it's not going to raise its interest rate from minus 0.25%. There's around $7 to $8 trillion of bonds in the global economy with negative interest rates. Primarily in Switzerland, Japan, some in Germany, Sweden, Denmark, and so on. And as a result, this is because these economies are still looking very weak. They've got very low inflation. Central banks are desperate not to have prices actually start falling in their economies because they're so indebted. So the one thing that really kills the financial system is there's lots of debt is if prices start really falling. And that's when people really do default. And so we've had central banks buy around $15 trillion of assets since the crisis. So effectively central bank balance sheets have gone before the crisis of about $5 trillion up to a bit over $20 trillion. And so they're still sitting on these assets. So in terms of stocks, we're still living in a very stimulated world with very low interest rates and very high levels of central bank printing of money. And so as a result, expectations of where interest rates are going to go are still very low. So perhaps the Federal Reserve at the peak of its tightening cycle might get to 2%. It may have couple more rate rises left, but the system is still too weak or still has very low inflation. That's the way it's going to go. Now that is in the post-war period, that is completely unprecedented. And the big worry for policymakers is that if they can't get interest rates up now, what happens at the next recession, next depression, next crisis? Because you'd expect a crisis to be addressed by the central bank cutting interest rates. But if we're already close to the lows, and there's a low on how far an interest rate can be cut. So the Swiss are about at the low it can be. Minus 0.75% is about as low as it gets until the whole system just wants to move into cash or into commodities that don't lose them any money. So central banks are very worried that we're going to be coming back to a period of negative nominal interest rates, and they're going to be out of things to buy in terms of financial assets or out of things to cut in terms of interest rates. And so in the back rooms of all the central banks, they will now be thinking about the really radical measures that they might have to take next time we have a recession. And these could be things around stopping you taking out too much cash from your bank, stopping the banks taking out too much cash from the central bank and warehousing it. So one rational thing would be in a very extreme negative interest rate world, a bank will just take cash from the central bank and put it in a vault to avoid the negative rate. There will be limits on that. You might even be taxed on your cash to try and force you not to hold too much of it, so that you can introduce a way in which you tax cash and things like that. They are very, very worried about if cryptocurrencies take off in a big way, then all of a sudden these are a competitor to the central bank money or the banking system money, because a cryptocurrency, you don't get charged a negative interest rate. You can't get charged a negative interest rate. It's just a token of exchange, store of value or not. That's the big question, whether it's a Ponzi scheme or not. So that's one thing that the central banks are very worried about. So we've got this sort of strange conjuncture where things are placid on the surface, but sort of quite fragile underneath. And there's a lot of technicals in the stock market and so on that suggest that we are close to, if a big shock occurs, stock markets could fall dramatically. So you could be looking at a sort of 30 or 40% fall in stock prices very fast, because the system is sort of getting very tight, very taut in how far it's stretched in terms of valuations. So that's where we are currently. A few observations on all of that. Just to emphasize, the system has very high levels of debt across it relative to GDP. So we're at record levels globally, over 300% of GDP now, for total non-financial debt across the system. Different countries have different heavily indebted sectors. Sometimes it's government, as in Greece or Japan. Sometimes it's the banking system. Sometimes it's the corporates, as in China. Sometimes it's the households, as in the UK. Portugal has sort of high debt levels across every sector. So it's sort of, in one sense, the most indebted economy everywhere. It's no surprise that, partly because of that, interest rates, as I said, are at record lows historically. We have interest rate data going back to the Sumerians, 3000 BC. Interest rates have never been this low historically. So 5,000 years of human history, you live in extraordinary times. And this is not a surprise. Interest rates are low. It allows people to borrow. But because the debt is there, it's now very hard for central banks to raise interest rates. Because as soon as they start doing that, and borrowers have to refinance their debt, it gets very expensive for them because the debt burden is so high. So this is why interest rates are going to be very low for very long, because particularly governments cannot afford a higher debt interest bill. As I said, equities and bonds are extreme valuations. So on most measures, the US stock market is way overvalued by historical terms. So the only times that the system has been more stretched have been 1928, before the stock market crash, and 2000, before the dot-com bubble. So we're in the sort of very extreme valuation territory, apart from everything other than interest rates. And then, as I said, we've got very subdued inflation and wages. The reasons for that, people are thinking they're a combination of still continuing globalization of production and labor. So you have had lots of headlines about Trump populism, trade wars, walls on the Mexico border, and so on. But not a lot has actually happened. So there's been a lot of rhetoric, but there's been a few skirmishes with the odd tariff on Chinese steel and so on. But the globalization of trade has sort of been maintained. And there hasn't been a lot of challenge to it. Now, US and Canada and Mexico are sort of haggling over the terms of NAFTA. There's Brexit, and we don't know what's going to happen with the trade deal there. But largely, global production chains are still in existence. Trade has not been majorly disrupted. There's still pressure on labour markets because companies can still move production elsewhere. And so there hasn't been a big shock to allow domestic labour forces to say, right, wages are going up. Companies can't move production elsewhere. And there's still lots of migration pressures. So I think Italy is on course for 100,000 migrants plus this year. So part of that pricing weakness and labour weakness is that companies and households are in debt, and they can't afford to withdraw labour or lose market share easily because they've committed their future income. So student debt, for instance, is a classic way of disciplining your labour force at the high end. They've got to carry on working to pay off their debt if they're not going to go bankrupt. So Mrs. Thatcher knew this. The way to control the miners in the UK in the 1980s was get them to have mortgages, sell off their their houses to them, get them in debt, and try and control the ability of people to go on strike through their debt. But this is now happening essentially in our population. We're reverting to a debt serf, debt slave society, where people cannot strike, cannot withdraw their labour, and don't have the power to do so because of their commitments. We have very low productivity growth going on in the world economy. So, and there's lots of reasons as to why this is, but essentially the underlying growth for the same inputs of an economy are growing at maybe roughly 1% through the application of new technology. Now, in the 1990s, we'd be up at 2.5% or 3%. And so the system, the growth capacity of the system has slowed dramatically. That's a combination of both an aging population, but also the technological improvements we're bringing in aren't resulting in a big change in productive activity. They're largely saving capital. So if you think about the big things that have occurred recently, the Ubers, the Airbnbs, Amazons, and so on, it's actually all about saving capital or making redundant capital that's already there. So nobody's building hotels now because Airbnb can sort of use the existing capital in people's houses to replace the need for more hotels in cities. We're not needing a lot of taxis because Uber comes along and uses the existing car stock more efficiently. Maybe a half of all US malls are now redundant because of Amazon and so on. So the internet competition that's going on is reducing pricing power, keeping prices low, but also not leading to big productivity gains. We haven't had a big improvement on transport. Self-driving cars are sort of still some way away. We haven't had a big breakthrough on energy. Nuclear fusion is still maybe 30 years away to decarbonize the power grid. We're starting to sort of get some big breakthroughs on gene therapy and so on in medicine, but we still haven't got a big productivity enhancing breakthrough there. So robotics may be coming, but it's not here yet. So apparently there was an orchestra conducted by a robot this week with one of the world's leading opera singers. And so it was there managing to conduct, but it couldn't manage a change in tempo. So robots can do the basics, but it still can't replace humans in everything. So you've got these sort of pressures that are reinforcing this low growth, low interest rate, low inflation environment. What are the relational consequences of these trends that are going on? Well, as I've said, one of the big problems within Western economies is that the distinction between those with assets and those without is growing dramatically. That's both a rich-poor issue, but also a young-old issue. So everyone from my age upwards have had it very well. So in terms of, I got paid to go to university. Everything was paid for me. I was able to get a relatively cheap mortgage and a cheap flat that is now 5 times the value, and so on. I haven't, demographically my pension is looking very nice and so on. And after my generation, all those benefits were taken away. So the ladder was sort of taken up intergenerationally. So if you're in your 20s and 30s now, you had a much weaker payoff from the intergenerational game from the casino. So I think it was calculated a few years ago that in the US, if you were born in sort of 1940s, if you were retiring in, I think it was, yeah, if you were retiring in 2013, your lifetime expected draw from the government was $250,000 in healthcare, in pensions and so on, relative to your taxes. If you were being born in 2013, you would expect to contribute $250,000 to the US government over your lifetime. It's that sort of dramatic a change in sort of benefits intergenerationally. And this is leading to some of the populist angst that there is in Europe and the US, because the gains of what economic growth there is have been concentrated at the top, particularly in the US. So real household income in the US for the median household has not risen for over 25 years. All the gains in income have gone to the top 10-15% of the income distribution, and then the wealth distribution has been even more skewed than that. So in terms of the US distribution of wealth, we are back to the extremes of the 1920s. And hence this sort of feeling of, amongst the majority of the population, is that they're not benefiting from what's going on. That's being exacerbated by corporate abuses of managers sort of exploiting their position short term to extract rents from their companies whilst the rest of the company isn't doing very well. So what's been going on in Wells Fargo, for instance, one of the largest banks in the US, they've had their mis-selling scandals as well, where the sales pressure from the managers at the top was so strong that employees started inventing accounts or creating credit cards for their customers and billing them for it, because they were being told they've got to make sales targets in order for the managers to juice the stock market, stock price, to exercise their own options. So the Experian example this week, where a credit rating reference agency was hacked, releasing 144 million clients' data, was being done whilst they only needed to spend a few tens of millions of dollars on better IT security. But the managers were paying themselves more profit and ignoring that. Now the company itself will fail, I think, as a result of the legal charges. But managers were extracting rents whilst neglecting their core business. So you're seeing lots of examples of companies leveraging themselves up. Debt is cheap, and buying their shares back in order to keep stock prices up, because those managers have stock options. So this is how we've incentivized managers to think. Very short-termist, get debt up in order to keep share prices up. So this is leading to this perception of sort of populist anger at how those at the top are not sharing the benefits of globalization and other things. And then there's a big relational challenge we face in this demographic change, demographic turn, as the number of workers relative to the dependents goes down and down. So Europe and America are following the Japanese demographic pattern, slightly more slowly, but we're moving into the Japanese world. Very low interest rates, very low productivity growth, very high debt, and an aging population. There is a huge issue coming between the debts that companies and governments in particular have on their balance sheets, so that's at record highs, versus the debts that are off their balance sheets, that are their pension obligations, that they're not entirely accounting for fully. So just as a contrast, in the UK we make a big deal about the underfunding by companies of their pension obligations. And roughly that's about £500 billion at the moment of all the company schemes that have made commitments and still have pension obligations. If you value all their underfunding, £500 billion. The government in the UK now has published a number on what its pension underfunding for its workers is, and that's about 1.7 trillion. So for the UK government, the debt it acknowledges on its balance sheet is about 1.7 trillion, and its off-balance sheet debt, its pension underfunding, is about 1.7 trillion as well. So we worry about all this austerity on managing this debt that we acknowledge, but the debt we don't count is as big. And then of course there's the debt we're not even bothering to calculate, which is we've made legally enforceable commitments on the state pension in the UK, but we don't even calculate what that is. That's about 5 to 6 trillion that we've promised, but we haven't saved for. So there's this sort of, we only focus on the tip of the iceberg of the debt. Now, interestingly, this is coming to a head much more in the United States, in that a lot of these problems are at not just the national level, Medicare, Medicaid, and Social Security, where it is an issue, but it's a sort of slower burn issue. There isn't a trigger to force something. But at state and local levels, there is real stress now, where local government is finding it just cannot afford to meet the pension contributions to its firemen, its police, its teachers, and so on. And there are isolated pockets of runs on pension funds. So we only thought that you could have a run on a bank because you're worried about the safety of a bank and you take your money out. But actually there have been an isolated instance of runs on pension funds. So the Dallas police scheme, all the retired policemen who deferred their pensions and not taken them, all decided that the scheme was getting so shaky that they'd decide to take their pot out whilst it was still there. And so all of a sudden the Dallas police scheme had to shut down all the withdrawals from it. And that's happening in Kentucky as well at the moment. So the big stresses are in Chicago, in Illinois as a state, in Kentucky, Hartford, Connecticut, and so on. Schemes that are struggling because they're hugely underfunded. So there's maybe 3 to 4 trillion of debt in underfunded pension schemes in the US that isn't being sort of properly accounted for on balance sheet. So you've got these sort of big pensions deficits that has been worsened by a trend in longevity. So for the last 15 years, we've underestimated the trend in longevity. People have lived longer, a lot longer than expected. So if actuaries were doing the calculation 15 years ago, they would have been surprised at how long people are living. Interestingly, the latest data in the US and the UK suggests that actually longevity might have topped out, and that people are dying quicker in the US, particularly white middle-aged men, but it applies across age and racial groups, apart from African Americans, interestingly. And it may be the fact that obesity and opioid addiction and suicide rates are picking up enough to stop the improvement in longevity from just sort of natural life expectancy. So the UK the last 2 years' data has been a plateau in longevity in the UK. So we may be at the cusp of people actually starting to live shorter lives. So we're got this big issue about the care burden for older people and the relational consequences of that. Who's going to do the caring? Because as I've suggested, government is coming to the limits of its ability to pay. And this is before we get the full movement into an ageing population. So government, as you saw in the UK election campaign, which probably lost Mrs May quite a lot of votes, was trying to say we're going to have to shift the burden back to families. We're going to be taking a lot of older people's inheritances, their estates, to pay for their care, and you're only going to keep 100,000 or whatever as the household, and we're taking everything else to pay for the care. Not a vote-winning message, but it was sort of a sign that governments are starting to have to think that we can't afford it any longer. So having for the last 50 years, governments have systematically undermined family integrity, said it doesn't matter, we'll provide welfare, you can move to jobs and so on. All of a sudden government is going to start saying, oh, families, this is your problem now. The problem is that we've had 50 years of undermining family structure and integrity and spatial cohesion. So it's actually going to be very hard to put families back together to do this. But families will do it because the state is going to be a relatively high-cost provider of care. Because this is something that robots can't do. They can't really put people back into bed after they've fallen out, or wash them in the morning, and so on. And so caring in a non-family environment is expensive and is going to stay very expensive and unreliable. And so families will actually start relocating in order to save on the care cost. So there will be a forced re-relationalisation of the family structure for elder care. So just a few final points on the trends and issues that you might want to think about going forward. As I've said, technology is disrupting lots of sectors, but we're not quite sure how far it's going to go. So people are thinking about how far is robotisation going to put most middle-class service jobs out of sort of viability. We're not sure yet how applicable robots are going to be across the labour force. This is driving an idea that we're going to need a basic income for everyone because so few people are going to be employed. As I said, we're not sure at the moment whether longevity trends are going to continue improving or whether the lifestyle consequences of modern life are actually going to force the decline in longevity. On environment, despite what you're hearing about 2 hurricanes, we've got a relatively benign outcome at the moment. The world is benefiting. If it is warming, it's benefiting from that warming. Extreme weather events are declining. Global food production is at record highs. So we are feeding, whatever it is, close to 8 billion people, 7.5 billion people, relatively easily at the moment. Global population is going to top out at 10.5 billion, given reproduction trends, particularly in Africa. If that's reproduction slows down as income grows, population is going to top out at about 10.5 billion. That doesn't seem to be that much of a problem to feed. What we're forgetting is that if you pump lots of CO2 in the atmosphere, this is a natural fertilizer. So green coverage of the global sort of land surface is 15% higher than it was 30 years ago. Doing my mum's garden, weeds grow very, very fast now because we've got so much CO2 in the atmosphere. In terms of energy, frankly, until we get nuclear fusion on a commercial basis, fiddling around with solar and wind doesn't make any difference. We're still going to need a lot of fossil fuels. And so technological improvement may make them less unviable, but solar and wind still need a lot of subsidy. But it's not going to be the end of the world if we don't get there. But I think the main trend you've seen is this extreme polarization, not just in wealth and income, but in outlook. So you're seeing just extreme tribalism within Western societies being facilitated by self-selection of what people read, what they see in the media, and so on. So the internet is allowing this sort of self-selection bias, confirmation bias, to be reinforced. And the sort of derogation and denigration of anyone on the other side is particularly marked in the US, but is growing here. And so because we're not interacting with people who think differently, either in our extended families or in our churches or in our communities, we've got the sort of self-selection into sort of marked factions politically. And that's a big relational challenge for us. We're reaping the whirlwind of high mobility, breakdown of community and so on, urbanization. So individuals then choose their peer groups. And those peer groups are splitting apart in terms of their social interactions. So that, I think, is a sort of dangerous relational trend we need to worry about. I mean, people are talking about what would a civil war in the US look like now. And it's difficult to know how that would come about, but it's amazing that it's being talked about. California there's I think the petition for California separation from the United States is gaining ground. Difficult to know how California could exist fiscally without the rest of the US, but people are thinking that. We've got a big issue with Catalan independence referendum coming up in a few weeks. So there could be a sort of catalyst for very extreme sort of political combat, well, not violent combat, but sort of extreme political outcomes in Spain. So we seem to be getting this sort of, whilst the world economy is doing fine at the moment, this sort of division into political tribes or national tribes seems to be gaining ground. So I think I'll finish there, having spoken far too long.